Hello, everyone. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today's our webinar's title is Key Criteria to Dispose of Stocks in Our Portfolio. So welcome everybody. So my name is Shen Chu. I'm the moderator for this webinar. Now, buying stocks is a science because when we buy stocks, we tend to follow a logical process to arrive at the buying decisions. But when it comes to selling stocks, then it will be an art because it often involves, a variety of emotions coming into place before you sell and after you sell, right? So after you sell, you often see how the price react. Then, you may feel, regretful to sell too early, or you may feel other emotions. So it is always very tricky when it comes to disposing stocks. So today we are going to look into some of the criteria when it comes to fundamental analysis and how do we dispose of stocks in our portfolio. So disclaimer, whatever we will share in this webinar is only for educational purpose. So in no way that will give you any recommendation for you to buy or sell any listed securities should we mention here. So if you decide to make any investment decisions, you are 100% responsible for all your investment risk. So allow me to briefly introduce our speaker today. Our speaker today is a content producer on kclau.com. He has written 200 over articles on kclau.com and is also a weekly webinar host and presenter. So he is also the co-founder of dividendvault.com, where he manufactures savvy investors who can build dividend-based portfolios independently, specifically in Malaysia, Singapore, and also Hong Kong. He is a dividend investor himself. He invests primarily for dividend income, and his dividend yields ranges between 2 to 8% per annum. So he's none other than Mr. Ian Tai. So Ian, welcome to this webinar.
Hey Shane, thank you so much for introducing me. And
Yes.
once again, yeah, I mean to say so excited, always excited to be on your platform. Yep.
All right,
yes,
you can go ahead and share your screen.
Oh yes, of course. Right, so I can actually start right away, right?
Yeah.
Please. Okay.
Can't wait to learn from you.
All right, sure. So once again, I would like to thank Shane for always so kind of you to actually introduce me. And it's always a pleasure to be on the platform here with LifeChamp to actually speak to Bursa Malaysia, the audience at Bursa Malaysia. So it's a privilege. It's always a privilege of mine to be on this platform. And guys, yes, today I'm going to talk about something which is about selling stocks. All right. Because usually what we do is that we usually talk about buying. How do you actually buy stocks? Today is a little bit different. We're going to talk about selling stocks. Now, I'm actually quite excited here, but so maybe we can actually start off with some warm-up questions. Perhaps you can actually type in the chat box. How many of you here have an existing investment portfolio? Perhaps you can actually type in yes, and let's see the response. All right, so yep. A lot of you guys are not newbies. All right, so a lot of you guys have some form of experiences when it comes to investing in the stock market. Very good. Okay, so I'm gonna just ask you another question, warm-up question, just to get to know you a little bit better. How many of you here? Oh, there's only one newbie. So yeah, you'll be in for a treat. So the next question I would like to ask you guys is actually this. How many of you here have more than 10 stocks? Perhaps you can actually type in the chat box, how many stocks do you currently own at this moment? So if you have less than 5, put any number lesser than 5. If you have 5 to 10 stocks, put 5 to 10. If you have anything like 15, 20, 25 stocks, you can actually put in the amount. All right. So let's see what's your response. So we have one Kok Weng, 25 stocks. Wow. Muhammad Rushdi, 25. So I'm going to just read out some names here who has more than 10. So Siu Eng Giam has 12. Shirley Hao, 5 to 10. Seng Fu Yong, 20, Arjun Singh, 18, Ng Seng Hock, 30 stocks. Okay. All right. The highest I think that I find here is actually 35. Nida Muhammad Ibrahim, 20 to 25. Okay, Dr. Roslan. So pleasure to have you on this platform. 25 stocks. All right, fantastic. So I believe that most of you guys have actually invested into more than 5 stocks. So the question is this. Final question, final warm-up question before we get into the session. From these stocks, right? How many of you have some of these stocks? How many of you have currently incurring capital losses from these stocks? Perhaps you can type in, if let's say yes, you can type in yes. If let's say all your stocks are in the black, which means to say you are in the capital gains position, then you just type in no. Let's see the response from you guys. All right, so okay, so all right, so most of you guys have some form of capital losses. Okay, so I think this is actually quite normal because I myself, I also have capital losses. All right, so thank you so much for your participation. Now let's get into the webinar. Right. So guys, when it comes to buying and selling stocks, in this particular webinar, I would like to set the context, right? And the context for this webinar, right, is that I am actually building an investment portfolio. Okay, so what do I mean by that? Now, for instance, a lot of people who actually buy into stocks, right? For me, they may not necessarily be investing. They may not necessarily be an investor who is investing to build an investment portfolio. Some of them are speculators, some of them are traders, some of them are just merely trying their luck. But here, the context here is that I personally, what I really want to do is to build an investment portfolio. Okay, so it's about investment. And here is my personal objective. So let's say my personal objective is as follows, as you can see on the screen. It is to accumulate fundamentally solid stocks. Okay, so fundamentally solid stocks for their income and cash flow productivity over the long term. Okay, so there are 3 keywords over here. The fundamental must be solid. That's the first one. Second, the fundamentals are actually assessed based on their income and cash flow productivity. And the third one is that the duration of this investment is actually long-term. So what I mean by long-term can be many, many years, possibly decades, possibly forever. So my long-term is actually not 1 or 2 years or 2 to 3 years. My long-term is for life. Okay, so that is actually the context and my personal investment objective. So in general, the attitude is actually this, which is that whenever I buy a stock, all right, it's kind of like a marriage. I really like married to the stock, and it's gonna be like for a lifetime. All right. So whenever I buy a stock, it's never to sell, never to be traded. It's actually to keep for life. Okay, so that is the general attitude. So guys, all right, before I continue, if you actually come across any questions along the way, just put it in the Q&A box. And of course, if you have any comments along the way, feel free to type that in the chat box. Okay, so comments in the chat box, questions in the Q&A box. All right, so let me just continue. So basically, when it comes to assessing a stock deal, right? So for me, this is actually my mental picture, how I look into a stock. All right. So when I look at a stock, I'm looking at it from a business point of view. All right. So which means to say, as an investor, I will actually put on my thinking cap. I will actually try to think like a business person. All right. Because a stock to me is not for trading, it's for business. It's actually a business. And what I will do is that I want to assess its legitimacy. It has to be a legitimate business that has real customers, that produces real products and services, that adds value to its customers. And here, this business, right, what I will do is that I will buy it, I will keep it so that I can actually earn recurring income. It can be recurring earnings, it can be dividends, and it has to be for the long term. So basically, this is actually the mental picture. All right. Now, when it comes to assessing, when it comes to deciding whether or not I should buy into a stock, okay? So I personally, I will use this framework, all right? So I'm actually pretty diligent when it comes to this framework. So it seems like I have a structure. Yes, I have a structure. I have a system in place that I personally follow in order to assess a stock deal. So this is how I do it, okay? So the first one is that I will look into this framework, which is kind of like a quadrant. So there are 4 quadrants to it. The first one here is actually business. The second one is actually the financials. The third one is actually the growth, and the fourth one is valuation. So I'll split them into 4 different quadrants, each of them like 1/4, 1/4, 1/4, 1/4, or 25% each when it comes to the weightage. So the first one is actually on the business side. So when it comes to business, I have this preference where I will actually look into cash generating business. So what do I mean by that is that, let's say, for example, you go to a coffee shop to actually drink coffee. So the thing is that so let's say you go to Coffee Bean or Starbucks, you probably just pay first. You pay for your order, and then you pay for your coffee, and after that you receive a coffee and you consume your coffee. Either that, or you order your coffee first, and then after you have consumed your coffee, you kind of like have to, there's no such a thing called put it on the tap. You pay for your coffee and then you walk, and then after that you exit the coffee or the coffee shop, right? So this is actually cash business, which means to say the sales is actually done through cash. All right. So that is actually my preference. Of course, there's another type of business where they do credit sales. All right. So credit sales is like kind of like your, like for example, project-based kind of companies whereby, okay, the project is worth 100 million, but then it's kind of like property development. It's like, okay, we actually completed a certain percentage of the project or the development process, 10%, then I receive 10%. Then after that, I complete another 20%, then I receive another 20%, and then so on and so forth. That's one way of looking at it. Or it's also a bit like manufacturing where, okay lah, I manufacture something, and then I allow my retailers, all right, I give them the product, and then I give them a 30 days, 40 days, 30 days, 45 days, 60 days kind of credit term, and then I have to like collect cash from them. So that's credit-based sales. So in general, I like the cash. I will have a preference for the cash-generating business. All right. Okay. Then of course, because of my objective, where I tend to be a bit more long-term, so I like it better if they have a recurring income model. And of course, I won't say I don't like. I would just say that if the stock, all right, the business, right, if it's serving like millions of customers, that would be awesome. I would prefer that over a business that is serving 10 major customers. So that is actually on the business side. So if I see that the business is good, then I look at the financials, which talks about sales, profits, operating cash flow. If this tree is done, dividend shouldn't be a problem. And of course, when it comes to gearing, when it comes to its debt levels, I prefer it where the stock is quite conservative when it comes to that. Okay, so this, when it comes to the financials, is something like that. Growth is actually about the initiative that the management is undertaking. What are the projects? What are the investments they are undertaking in order to sustain the business growth into the future? So that's growth. And last but not least, we talk about valuation, where I kind of like use these 3 very key valuation ratios in my assessment when it comes to deciding on the stock investment. So that would be PE ratio, PB ratio, and dividend yields. Okay, so this is the quadrant. Now I spent a little bit of time over here. Understand? Please bear me free. So when it comes to this quadrant, right? So I know it's split into 4 parts, but essentially they are just 2 components. All right. So the first 3 here, business, financials, and growth, right? These 3 are related to the fundamentals of the company. Okay, so this 3 takes up 75% of the 75% of the assessment, okay, assessment process. So which means to say the weightage, the higher weightage will be on the fundamentals of the stock. And then the second part will be, or I would say the final component of this quadrant, right, will be the valuation, okay, which is the PE ratio, PB ratio, and dividend yields. So I would say that I will put 75% of my focus on the business, on the fundamentals of a stock, and then 25% will be on the valuation. So this is actually just this is actually my own system and the structure that I use when it comes to assessing stock deals. All right. So this is actually my background. Now I'm going to just review to you my own personal framework when it comes to selling stocks in our portfolios. Because just now from the warm-up question, I realized that most of you guys have a stock portfolio, just like myself. I have a stock portfolio, but then the thing is that from out of this stock portfolio, right, the question is that which one should we keep, which one should we hold on to them for a longer time, and which one we should actually just which one it seems that this is actually a good deal and we can actually add more of these shares into our existing position. Okay, so therefore we need a framework, or at least I need a framework. So now I'm just going to share it to you how I will actually personally go about it when it comes to selling stocks, choosing stocks to sell in our portfolios. All right. Okay. So this is actually my my framework to dispose of stocks. Okay, as you can see, we have the fundamentals, which is F, and then we have the valuation, which is V. Okay, so we have F, and then we have V. So in general, what happened is this: when I find a stock that is fundamentally solid, which is good here, and if the valuation is also very good, so it kind of like fulfills the framework, the quadrant that I talk about. Good fundamentals, good valuation, of course, the decision to invest in the stock would be very easy, which is to buy into the stock. All right. So that is actually the ultimate goal. But sometimes, right, it's not always the case. In our portfolios, maybe we have 10 stocks, 20 stocks, or 30 stocks. Okay. As I build my investment portfolio, sometimes the fundamentals of the stock can be good, but then the valuation not too good. Okay, that could happen. And there are also instances whereby you buy into a stock, the fundamentals of the stock used to be good, but then it turned bad or it turned sour. All right, so this could be investment mistakes. Okay, or it just simply means that the stock, when you assess it, it was good, but then over time it seemed to have deteriorated for some reason. Okay, maybe the industry, maybe there are many reasons for it. All right, but sometimes it's just uncontrollable factors that actually come in that causes the fundamental of the stock to have actually go from good to become bad. And of course, when it comes to this case, right, when the stock has become fundamentally bad, usually, if you look at the valuation, it doesn't matter whether the valuation is good or bad. If the fundamentals is bad, it's bad lah. All right. Usually we'll just sell. Okay. So this is actually the simple framework. So the question is, how do we go about it? All right. Which one should we focus on first? Now, let's say for example, we have a portfolio, right? Which of the three should we focus first? Now let's look at how I will go about it. All right. So this is where I will focus on. So let's say we are starting from here. So from your stock portfolio, from my stock portfolio, what I will do is this. Okay. First, the ones that have capital appreciation or the ones that have capital gains, just put it aside first. So let's say, for example, you have 20 stocks, and maybe let's say you have 10 stocks, 10 out of 20 stocks that have capital gains. So that one, of course, since there's capital gains, you just put it aside first, right? Because you are on a capital gains position. And right now we just focus on the 10 where you have capital losses, okay? But from these 10 capital losses, right, we do not know three things. Number one, is it because the capital loss, right, is it due to a deterioration of the stock's fundamentals? That's number one. We don't know. Or number two, is it because that the stock's fundamental is actually very good, but you bought it at the wrong valuation? So that's the second one. We don't know. Then the third one is that maybe it's not because of the fundamentals of the stock. Maybe also it's not because of the valuation. But when this happens, right, it can also mean that your stock, when you buy that time, the valuation is attractive. Now it becomes even more attractive. So therefore, you may actually want to consider buying more or buy more shares of these stocks. So there are three possibilities of that happening. So how do you identify which of the three is actually true? Okay, so this is how we go about it. The first one is that we need to actually assess. Now we are focusing on the 10 that is actually on capital losses. So out of these 10, what I will do first is to reassess the fundamentals. Okay, so let's say from these 10 stocks that have capital losses, maybe 5 of them, okay lah, don't say 5 lah, just 3 of them, the fundamentals of the stock has turned bad. From good, become bad. So when that happens, right, when the fundamental of the stocks become bad, actually it doesn't really matter what valuation already. Here, if the fundamentals of the stock is unsalvageable, then the decision here to be very business-like is to sell off the stock. Okay, so that is if the fundamentals of the stock has become really, really bad and it's not salvageable, then sell. Okay, that is step number one. Then we move on. Then once we have actually taken care of that, we have gotten rid of all the stocks that are fundamentally bad. Now you are just left with 17 stocks. Okay, that means the 10 that has capital gains and then the 7 that has capital losses, but the fundamental is still good. Okay, then we move on to the second part over here. So let's say from this fundamentally good stocks, right? The question is that what is the valuation like? So if let's say the valuation is bad, okay, which means to say you bought it, maybe you bought it at when it was overpriced. Okay, when it was overpriced, that is the time where you can actually decide for yourself whether or not you should sell the company, or you should sell the stock, or you want to keep on further. That one is actually debatable. Okay, it can be you can actually sell the stock or you can actually keep the stock. It's up to you. All right. So that is actually the second part. And once you have actually decided on this, maybe you find that some stocks, right, the fundamentals are okay, the valuation is okay, then maybe you can actually consider buying more of these stocks. Okay. But where do you get the capital to buy these stocks? You get it from here. Okay, you see here? Which means to say you get rid of the whatever the price is, you get rid of the stocks that have poor fundamentals. You recoup back the capital. You recoup back the capital over here, and then you reinvest your capital over here. Okay. So that is actually how I will reconstruct the portfolio. Okay. All right. So with that, let's go dive in deep. Let me just walk you through how this is done practically. All right. So let's move on to step number 1, where we are going to assess the fundamentals of the stocks in our portfolio. So the ones that you should be studying first is the one that has capital losses. All right. The stocks that have capital losses, study that first. So now we reassess the fundamentals of the stocks in our portfolio. Okay, guys, I have actually prepared 4 stocks. All these are Bursa Malaysia stocks. Okay, I won't tell them. I will tell you what exactly they are. We have stock A, stock B, stock C, stock D. Now the question is this. Okay, which of these stock would you keep? All right, maybe you can type in the chat box and let us know. All right. All right, so let's see. So a lot of you says A. Okay. All right, fantastic. A lot of you actually want to keep A. So we have Mr. Yao Kian Kiong says A and D. A and D. All right, but most of you says A. All right. Okay, the next question is this. So a lot of you guys actually want to keep stock A. That is understandable. Now I would like to ask all of you guys, all right, so many of you here, what about stock B, C, and D? Okay. B, C, and D. How many of you want to keep B, C, and D? All right, so we have one Muhammad Rusdi. I like D because turnaround company. Okay, that's your comment, because you see that there is this. BC don't want. Ken Courses will keep stock D. Eng Zhixian D. D is cyclical company. Okay. Augustine Cox says D. Okay. All right, so fair enough. Some people actually will want to keep stock D. All right, so let's say, for example, for me personally, for me, maybe I'm a little bit more rigid. I don't actually look at turnaround companies because I don't trade. I only want, I only want something that has, that is evergreen, all right, that is ever rising when it comes to profits. Okay, so this looks like the kind of company that I will always want to keep. And usually for me, when it comes to my portfolio, I only keep stock A lah. So you won't find me having a lot of, you won't find me having stock B, C, or D. All right, when it comes to the financial performance, you can see, I will say that currently the characteristics of my portfolio is only stock A. B, C, D will not be in the show. Of course, B is like, you see, when it comes to B, right, the shareholders' earnings, right, every year is profitable, but you can see that when it comes to the long term, right, we can see that the earnings performance, the results, financial results for stock B has been declining when it comes to earnings. So this is something that I don't really like to see in my portfolio. So stock B is the one that I would throw. Stock C, if you can see here, it seems to me that it is a company that has been incurring losses all the time, except for one special year in that many years. It's profitable. So this is actually a stock that I will actually dispose immediately. And when it comes to stock D, the thing is that it's profitable here, unprofitable, a little bit profitable, unprofitable, profitable, unprofitable, and then profitable. So to me, this is, I mean to say, rather than keeping this, I will actually just dump this stock D. I prefer to just channel it to keep stock A. So that is actually for me. Okay. But anyway, thank you so much for your what do you call, your comments, learning something from you guys as well. So over here, let's say we continue on with our webinar where the majority says that we're going to just keep stock A, B, C, D, we'll just throw it away. All right. Now, here's the thing. Some of you actually have already commented, but just want to get your opinion. All right. Maybe you can type in the chat box. So the question is this. Okay. Although the fundamentals of stock B, C, and D is not as powerful as stock A, but then the thing is, if let's say you sell off the stock, stock B, C, or D, how many of you guys have this concern that What if their stock prices could actually recover in the near future? What if I sell it today and then it could possibly rebound in the future? How many of you have this kind of concerns? Maybe you can type in the chat box. Or if, let's say, for example, if you're comfortable with selling off if let's say you're comfortable with selling off B, C, and D, no worries, no emotion. You can forget and move on. All right. You can also type in the chat box. All right. So how many of you have some emotional attachment to B, C, and D? Put in yes if you have. Put in no or forget and move on in the chat box. So Jusnida says forget and move on. Siu Engiam says done. Forget it, move on. Ng Li Ching says yes. Liu Ken Yik, yes. Chua Chu Bun, yes. Lim On Ping, no. We have Tan L Hop, yes. Q Ngo Hao, yes, yes. Chu says yes. Mr. Yap says better to swap to better stocks, no regrets. All right. Arjan Singh, used to, but no longer. Augustine Kopp, just move on and never look back. Yao says will have, but if decided, then move on. Fong says move on. Ng Zhi Sean or Sin says no, don't be emotional when it comes to money. Yeah, but the thing is, we are all emotional creatures, right? Yeah. Shirley House says yes. So as you can see, so many people. Peter Ling, I may get hurt. Okay, so guys, it's 60-70% of you guys says yes, it's a concern. There are 20-30% of you guys who says no, firm. Once you have decided, just move on. Okay, so what is the response? Just picture this, okay, when it comes to selling all this kind of, when you're thinking about stock B, C, and D, imagine this, okay? Imagine this, put this, now you can type this in the chat box, okay? All right, imagine this, when you are selling stocks. Let's say you're in a relationship, boyfriend, girlfriend, all right, relationship. You are in a relationship that is not working. Your spouse or partner is dumping you for another person. You know that it's a little bit hard to turn around already. What would you do? A, would you cling on to this relationship? B, just move on. So type in the chat box. So most of you guys say B, 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 B. All right. So nobody actually wants to cling on to a relationship that is not working. It's the same principle. If the stock, right, is loss-making, profits are declining, unpredictable, inconsistent, it's like a relationship that is not working. All right? Just treat that as a spouse or partner that is dumping you for another person. All right? Just the most important thing here is to learn from it and probably just move on. All right? So that is actually the I believe there are some similarities when it comes to this this typology. Okay, when it comes to, because the thing is that when it comes to finances, when it comes to relationships, both of them can be emotional. So therefore I believe that these two are actually quite similar in their nature. Okay, but here I'm just gonna elaborate a little bit further about cling on and move on. All right, before we actually move on to the next part of this webinar. So for people who cling on, right, you'll find this in the stock market. There are a lot of people who actually cling on because when they cling on, all right, so these are people who actually bought into a fundamentally poor stock like that. there's a comment that says, Dato Dr. Roslan says, don't look back on these stocks. Foresee with that kind of financials, how could one acquire it in the first place? Yeah, exactly. But then sometimes there are people who buy, there are people who buy into this kind of stocks, but they are not investing because their mindset is not really into investing. They are looking at it apart from investing. All right. Many reasons of why people will buy stocks in the stock market. But anyway, let's say right now you want to change your thinking. You just want to focus 100% on building an investment portfolio. Clinging on simply means that this person actually bought into a fundamentally very poor stock, already incurred losses, but yet they still hope that maybe one day the stock price will recover. So that is for people who think about clinging on. Moving on simply means that we already acknowledge that this thing cannot work. It's a mistake. We accept the mistake. We just want to learn from it and move on. So the thing here is that we will choose to recoup back whatever capital that we can actually recoup back, recover it first, and then from this capital, we can actually be more productive in our subsequent investments. But this time round, don't make the same mistake as the first one. Be smarter in the next. Be smarter in the next one. All right. Don't go from one abusive relationship to another abusive relationship. Don't go from one bad relationship to another bad relationship. If let's say your previous one is a bad relationship, move on so that you can actually have a much better and fruitful relationship. That is actually the terminology or the typology. Okay. All right. Now we have covered the fundamentals. Okay. As you can see, the fundamentals. All right. How do you assess the fundamentals? You just take the earnings for every single, just take the stock. All right. Compile the shareholders' earnings. Just plot a graph. If it's stock A, keep. If it's not stock A, don't keep. Finish. It's as simple as that. Okay. If it looks anything but stock A, throw. If you want to build an investment portfolio. Okay. So it's as simple as that. Now, step 2 is when you all have the stock A already. Okay. You only have stock A. B, C, D, you have already buang. You have already like dispose it off, and then you recoup back some capital already. So out of these stocks that have capital losses but fundamentals are good, we have to recalculate the valuation. So how do we do that? Let's go through some case study. All right, guys. With that, we need to do a little bit of mathematics. So if you have a smartphone right beside you, it's time to take out your smartphone or your calculator. We're going to just do a little bit of maths work over here. All right. So here is case study number 1. So let's say, for example, we have stock E. If we look at the shareholders' earnings, it looks okay. It seems to be okay. Every year we can see profits. We have exceptionally high profits in 2021, a bit lower profits in 2022, but in general, the shareholders' earnings have been pretty okay. All right, so this is actually the financial performance of stock E. Now, here is the thing. When it comes to reassessing stock E, the thing is this. You have kind of like bought it here when it was trading at 6.45 cents. Okay, you kind of like bought it here. Right now, as you recalculate the valuation of this stock, the price is now 5 ringgit and 22 cents. Okay, hopefully you guys are following. So I'm going to just repeat again. So this is a stock where you bought it over here when it was trading at 6 ringgit and 45 cents. So that's your purchase price, 6 ringgit and 45 cents. And right now it is trading at 5 ringgit and 22 cents. So right now you're at a capital loss. And right now we are going to just revalue the stock. Okay, we got to do not just a revaluation of the stock at current price. We also want to do a post-mortem whether or not this price at 645, did you actually buy it at a price where it is actually kind of like overvalued? So that is something that we want to know. So how do we do it? So we revalue stock E. So this is actually the post-mortem on your left. And this is the right-hand side. On the right-hand side, we will revalue the company, okay? So I'm going to just give you a very brief data. You can do this on PE, PB, and dividend yields, but I'm just going to do PE for today. So here's what you do. So here's what we will do, okay? For stock E, for 2020, the earnings per share is 9.8 cents, okay? For 2022, the earnings per share is 8.9 cents, okay? So if we go back a few slides, so you buy it here, fundamental solid stocks. Over here, the earnings per share is 9.8 cents. Right now over here, it's 8.9 cents, okay? So let's do some post-mortem. What was the valuation that you have paid for this stock, for stock E? So how do we do that? You take your original purchase price, which is 6.45. You divide it by 9.8 cents. So guys, can you actually put in the chat box? How many of you have actually calculated the PE ratio of your purchase price in the past? Maybe you can type in the chat box, what is the PE ratio like? So Eun Seng Hock is the first one to answer. So the answer is 65.81. Okay, so basically, yes, a lot of you guys are actually getting 65.81. How many of you think that 65.81 is a PE ratio that is really high? Also can put in the chat box. 65.81. Wow, PE ratio so high. Okay. Yeah. Okay, a lot of you guys say PE ratio is very high. Yeah, extremely high, too high, so high. All right, fantastic. Okay, now let's revalue the stock. Okay, so the thing is, in terms of its fundamentals, the company is still profitable. Okay, although there's a slight small deterioration over here, but then the thing is that it depends. This one is actually quite debatable. We don't expect every year to be very smooth like stock A going up, but then there are some instances whereby maybe you find this justifiable or acceptable, then you may actually keep it. All right. Maybe it's not exactly such a big deal, so we can actually keep this. So let's assume that we keep this. Now let's look at the current valuation. Now the stock price is 5.22. What is the latest PE ratio stock? Okay, so we take 5.22, we divide by 0.089. So we have Siok Cheng, Lim On Ping, Pang Chiu Hyung, Jusnida, Akin Lau, Eun Seng Hock, 58.65. So guys, any comments on the latest PE ratio? Is it still high? Or is it undervalued? Or is it fairly valued? Give your comments. So just now over here, we have 65.81, which is like, so very, very high. Okay. Right now it's at 58.65. Okay. Still very high. So the million-dollar question is this. Would you keep or would you sell off stock E? So Ng Zhixian says sell. Siok Chen says keep. All right. And then Ken Kaur says keep. Putri says sell. All right. Ng Li Chin says sell. Ben Lam sell. Pang Chiu Hyung keep. Lim On Ping keep. A lot of keep. A lot of people says keep. Change, if could find a better one. Q Ngo Hao, sell. Mahmoud, keep. Jusnida, keep. A lot of people say keep. Huh? Now, the thing is that it depends. For me, based on this data alone, if you ask me to keep a stock that has PE ratio of 58, I will be in favor of selling the stock, even though it's at a capital loss. All right. Why would I say that? Simply because if I bought here and the PE ratio is 65, and then over here, the current PE ratio is at 58.65. How many of you, all right, okay, maybe you can type in the chat box. How many of you here believe that you can actually find a lot of very, very good, fundamentally good stocks, right? Where the PE ratio is way below 50. All right. How many of you can find a lot of good stocks in the stock market where the PE ratio is so much lower than 58? A lot of people are very capable of finding that. So a lot of people say, yes, can, yes, can, yes, can. So to me, that's why I will probably sell. All right. All right. But no right or wrong answer. For me, 58.65, I'll probably just forget it and sell. I'll move the capital from this stock into some other things which is a lot better than this, and the PE ratio is maybe half of this. All right. So that is actually personally what I would do. All right. So that is actually my own take. You guys can actually refer. No right or wrong answer. But personally, I would sell. Okay. Because I personally believe that there are so many deals in the stock market where I can find really good companies, but the PE ratio is so much lesser than 58. All right. So it doesn't make sense to hold on to a stock where the PE ratio is still above 50. So that is actually my own take. Now, of course, over here, after step 1 and step 2, usually if you do your job nicely, you will actually recoup back some capital. All right. And over here, we can actually reinvest them into better fundamental stocks, which are trading at better valuation. Okay. So now we move into step 3. Of course, you will have a lot of questions. We'll welcome them. We'll love to actually address them at the end of this session. All right. So the thing is, what do we do? Okay. We will actually focus on the good stocks in our portfolio. Now, let's move on to case study number 2. Okay, so we have the past historical shareholders' earnings. As you can see here, it looks very good. Something that I personally will want to keep is like stock A. So stock F is stock A. Good. And let's say, for example, you buy here. You bought into this stock. I also hope that I bought into this stock at this time, September 30th, 2011, at the price of $6.59. Right now, we are over here, but the price is $13.50. So if you compare $6.59, you bought at $6.59, now it's at $13.50. Okay. And you're looking at stock F, you have actually doubled your capital. I'm not sure about the dividends. Probably you have, along the way, you have collected so much dividends every single year throughout this period. So over here, you have collected dividends and you kind of like have achieved capital gains over here. Now, based on this, how many of you will want to sell this stock? How many of you would like to keep this stock? All right, maybe you can put it in the chat box. Let us know. All right. So Jusnida says sell. Tik Kyong On says keep. Kenneth Yap says keep. Ben Lam says keep. CB Chua, sell. All right. Datuk says keep. A lot of you guys will say keep. For me, what I will do is that I will revalue this stock. Let's see how it works. So now we are revaluing stock F. Okay. So we have again the two EPS. You can use this interchangeably with when you calculate the PB ratio and when you calculate the dividend yields. I'm just going to explain the concept here with PE ratio. So stock F, when you purchase it that time, it was 2011. So the latest EPS would be 2010, where the stock, the earnings per share is 34.5 cents. 10 years, 10, 11 years down the road, the earnings per share right now has actually increased over time. It has increased to 86.5 cents. Okay, so now let's do a little bit of post-mortem first. So back then in 2011, this is the valuation that you have paid. Okay, so guys, maybe you can actually calculate the PE ratio that you have purchased, that you have bought stock F in 2011. So what you do here is you take 6.59, you divide it by 34.5 cents. From there, you should get your PE ratio. Let's see what you guys are getting in the chat box. Okay, Ng Seng Hock, Lim On Ping, Jusnida says 19, 19, 19, 19. Okay, fantastic. So 19, many of you guys actually says 19, very good. For those of you who have already calculated 19, so that is the valuation that you paid in 2011. Now it's today, current valuation. The latest earnings per share is 2021. The latest earnings per share is at year 2021, 86.5 cents. But then the stock price is 13.5. So what is the valuation for today? Maybe we can do a little bit of maths and put it in the chat box. Okay, a lot of you guys says 15.6. Okay, very good. So now, here is a situation. Okay. You bought it at 6 ringgit and 59 cents. Here, the PE ratio is 19. Now you have doubled your capital. Now you're actually looking at the same stock over here. It's trading at 13.5. But then the PE ratio is 15. Once again, how many of you would like to sell off this stock? Put it in the chat box. Okay. Feng Shui Hua says top up. Connie Chan says buy more. All right. Sutara Lingam, keep. Arjun Singh, keep. Ng Seng Hock, keep. All right. A lot of Yao Kian Kiong, add. Ng Li Ching, add. All right. So a lot of keep, add. Raymond says take profit and switch. That's trading, maybe. Vimalan says sell and rebuild. One Kok Wang says PE ratio has dropped despite share sharp growth. Keep. Datuk says keep. Jusnida says sell and take profit. Ng Seng Hock says buy some more. Eric Lee says buy. So what is my answer? Okay. For me over here, the PE ratio is 19. I buy. Okay. When I buy the stock at the time, the business is only making $137.6 million. Okay, let's say when I buy at 2011, the business is earning this much. Now it's 2021, the business is making 344.7 million. It's a lot more than what it used to make in the past. So my reasoning is that I cannot value the stock based on here. I have to value the stock based on here, which is 344.7. Okay. Over here, the PE ratio is 19. Here, the latest PE ratio is 15. 15 is below 19. So from my point of view, as an investor, I will probably, whoever says add more, I will say I'm with you. Okay. For those of you who sell, let's just say we are of different sides of the opinion. I will probably will not sell. I will say I will keep. If I don't have enough capital, I will keep. If I have already recouped back some capital from all the lousy stocks, I'll take that one and I'll put it into stock F. All right. So stock F is something that is worth keeping. And I believe that stock F is worth buying because the PE ratio is 15. It's much lower than what I used to pay for in the past. Okay. So to me, for those of you who says add more, you're getting the lesson. Congratulations. All right. At least that is actually from the context of an investor. Okay. If you're a trader and speculator, that's another thing already. But I'm not a trader or speculator, so I cannot comment on that. All right. Now let's move on to case study number 3. Okay. So this will be our final case study before the Q&A. So once again, this is stock G. Once again, stock G looks like stock A. Okay, so this is actually the price performance. So you bought here in 2011 at 71 cents. Then magic happens. As you can see over here, it seems that it has actually surpassed the 10 ringgit mark, 10, 20 ringgit mark. You are over here. So essentially you have already 10x or 20x your capital. All right. So now the question is, would you sell or would you keep the stock? All right. So this is actually something that we will find out. Now, once again, to decide whether we should sell off the stock, keep the stock, or buy more, we'll do some valuation. So this is stock F. All right. In the past, when you buy the stock, the earnings per share is 4.91 cents. Okay, so which means to say in the past, here is 4.91 cents over here. This is when you are buying it at 4.91 cents. Right now, you're seeing the stock over here. At that point, the earnings per share is 12.88 cents. So let's do some post-mortem. What was the valuation that you bought in the past? Okay, maybe you can type in the chat box. Eun Seng Hock is quick. All right, you have calculated that the PE ratio is 14.46. All right. Yes, many of you guys are actually getting 14.46, which is very good. How about the current valuation? Let's say over here, we just take the average figure, which is 15 over here. Okay. So 15, and then the latest earnings per share is 12.88 cents. What would be the PE ratio? The current PE ratio of this stock? 116.45. How many of you are actually getting 116.45? Yes, 116. So last time when you buy the stock, the PE ratio is 14.46. Right now, the current valuation, the PE ratio is 116.45. So guys, put in the chat box. How many of you say, let's just take profit, sell, and forget about it? Okay, many people says better run, sell. Fantastic. Take profit and run. Fantastic. All right, so thank you so much for the comment. Now the question is this, guys, we did so much mathematics. Now it's a bit of, now let's take some time to reflect. There is a difference between stock F and stock G, but what made the difference? Okay. When it comes to stock F, You buy 6.59, it's now 13.5. You have doubled your capital. But here, some of you guys, including myself, will say, we will either keep or we will actually buy some more. So that is actually stock F. But when it comes to stock G, we sell. Why? What makes the difference? Okay, some of you are actually getting it. All right, so some of you are actually getting it. It's PE, too hot, PE, overvalue. Chart looks ugly. Okay, the earnings did not match the rise in the share price. Correct. High risk, PE ratio too high, valuation too high, high PE. Okay, fantastic. A lot of people are getting the picture already. Overvalued. Many people are saying overvalued. Mustaqim, poor earnings. No lah, where got poor earnings? Okay. Like that, where got poor earnings? Earnings have also increased. All right. But can you see that the earnings increase? 142.9. Maybe from here to here, it has increased by 3-4 times. Here, the harga saham, naik 10 kali, 20 kali, 10 to 20 times. The stock price has risen so much faster than the earnings growth. All right. So this is a case where for investors, every investor will dream of this to happen lah. Time to take profit and run lah. Okay. So here's the difference maker, guys. This one very important. When it comes to stock F, all right, the stock price increase, right, is quite backed by its earnings growth. So you can see that it's justifiable with its business performance. If that is the case, we can actually keep, or I will personally keep. I say, hey, if the business performance is good, the earnings have increased, I will reevaluate according to the increase in earnings. And if let's say the stock price has actually reflected that, very good. That is stock F. But for stock G, when you have stock prices rising 10, 20 times so much faster, right? Like there's no reason why so fast the stock price actually increase. This could mean that the capital appreciation could be fueled by a lot of people, traders, speculators, uncles and aunties, young people, old people, people who are not supposed to be, people who are not exactly regular investors in the stock market. Suddenly they're all coming in, okay, to actually take a piece of action of stock G. That is the time we sell off and that is the time where we sell off and call it a day. All right, just enjoy the rewards of your investment. So we have to actually decipher which of the two is actually true. Is the stock price increase backed by the business performance, or is it by speculation? All right, so with that, I come to the end of this presentation. There are some lessons to be learned from here. So this is the art of disposing stocks. Number one, you have got to, I believe this is very important. Number one is that we need to know our investment objectives. So for me, it's purely investment, no trading, no speculating, just investment. Focus on the business, all right? That's number one. Okay, number two, if let's say, for example, let's assume that if I inherit a portfolio, the key thing here is this: throw away the ones that has poor fundamentals first. Just throw that and move on. Then after that, we look for, among all the good fundamental stocks, we see which one is overvalued, we throw that one as well. Okay. Once we got back the capital, we take the capital and then we will invest. We'll invest the capital into better fundamental stocks. Of course, this time round, make sure the valuation is right. And last but not least, there's always a jackpot. If let's say there's a fundamental good stocks and the stock price have been goreng by traders and speculators, congratulations. Time to take profit and enjoy the rewards of your investment. All right. But usually this kind of thing, not very often. But if it does, make sure you know how to recognize it and take profit. All right. So this is actually my take on the art of disposing of stocks. And that's it. So guys, thanks so much for participating. Hopefully you have benefited in a way on this topic. And back to you, Shane.
All right, thank you so much, Ian, for sharing with us the key criteria to dispose of stocks in your portfolio. So if you have any questions to ask our speaker, Ian, you may write them in the Q&A box here. So not the chat box, so we can easily manage your questions. All right, so we have got a lot of questions on our panel now. So, the first question is by Kian Kyong. For companies, that is not so straightforward, such as Alibaba, what is your view?
Okay, so first one is that if you want to avoid ambiguity, right, just go with all the stock A lah, and so that is actually the first one. But Alibaba is actually a case whereby, okay, so you have to first look at the fundamentals. So let's assume that the fundamentals is good, the price is actually dropping. Now the question is, would you want to sell off the stock, or would you want to buy more because the stock price has actually come down? All right, so that one actually, it depends. It depends on what is your objective. And if let's say you find that Alibaba has actually fallen in stock price and it seems to be a good deal and you like the business, the most important thing is that you must like the business. If let's say you don't like the business and you're thinking about, oh, what if the Chinese government do this or that? I mean to say, then if you're clouded by all these kind of things, then don't lah. But then if let's say you really genuinely like the business, you think that Alibaba has a solid business model and you find that the valuation is right, then yeah, you can actually choose to add on to your position. Or alternatively, if you have too much Alibaba, let's say Alibaba is like 25% of your stock portfolio, then of course you can either choose to add on, or you can say maybe you just want to look at other things so that you can actually reduce the weightage of Alibaba in your portfolio to build a much more diversified portfolio. Yep.
All right, thank you so much. The next question is by Muhammad Rusdi. If a company, take out loan from bank to expand their factory or business, is it good or not for investor to buy this kind of company?
That's a yes and no question lah. But the first and foremost thing is that you see, I'm making it a bit simple over here. You look at this the first criteria is that you look at this. This is the earnings here. If let's say the company that you talk about, right, is taking more debt or loan from the bank to expand, okay, and it doesn't have this kind of earnings, then no good lah. If let's say the company is looking like this when it comes to shareholders' earnings, you already check the operating cash flow. The operating cash flow looks very good. It's always positive. Then the question is, why would the company want to borrow from the bank, get a loan to actually expand? Of course, some of these companies also do that, but if they do that, also okay. All right. But I wouldn't say that would be a very significant deciding factor when it comes to buying a stock. What's more important for me is the long-term track record, the financial track record of the stock. That one is more important. If that one is not done well and the company take on more debt to actually expand, then no good lah.
Okay, thank you so much, Ian. Plastis would like to ask the next question. Do you have a rule of thumb, like you cut loss when it is down 10%, or you always reassess?
Usually we don't really cut loss. Usually the thing is that because we don't really look at capital gains or capital losses, we always look at the business side of things. So if let's say the business side of things is good, usually we'll keep regardless of the price. Of course, the thing is that if let's say the price have actually fallen by 20-30%, then, and if let's say the business is still good, then why not just grab more of this kind of stocks? So that means to say we will not operate like a trader. We don't actually say, oh, oh, the stock price has actually gone down by 10%. It's a bad investment. It can be opposite. Because the thing is that we buy to keep, because the objective is to keep for its recurring income. If it's recurring income, the model is good, its fundamental is solid, no reason to cut loss at 10%, because the whole game plan is not designed for that lah. But if you are trading, that's another thing already lah. Right, Shane?
All right, thank you so much, Ian. The next question is by One Kok Wing.
Mm-hmm.
Even if you hold stocks for long term, there should be a time to sell them if the situations change, or if the capital gain is tremendous. We can sell to get cash for other potential growth opportunities. What is your thought on this?
It depends on, first and foremost, this is kind of like the golden goose, and all these earnings here, every year it lays out more golden eggs. All right, so it lays out more and more golden eggs. Why do you want to break the goose? Okay, so it really depends lah. All right, so for me, I mean to say it depends. I'm actually quite content with the golden eggs. Of course, sometimes the time to actually, like for example, stock F, the reason why the case study is built such a way is that stock F is to illustrate that this kind of golden goose, I'll probably want to buy more of this golden goose. Whereas for stock G, where it has already become like that, it's time to cook up lah, roasted goose or something like that lah. So this is actually the time to kill the goose for its meat lah, But then the whole assessment, right, is not based on the stock price. As you can see, for all the stock, right, we don't look at the stock price. We look at the valuation. We decide based on the valuation if you are an investor. Yeah. So it's all based on earnings, cash flow, and valuation. Right, Shane?
All right.
Mm-hmm.
The next question is by Ang.
Mm-hmm.
If the valuation is historical, is there a way to buy based on expected PE?
That one is like, it depends. If you want to simplify your life, don't look at expected PE lah. Just look at the current PE will do. You don't need to speculate as to where the earnings will go in the future, unless you are very good in prophesying. But the thing is that for me as an investor, we go by the records lah. So as you can see, there's always a reason for everything in this slide. So like in this slide, right, we can see that all these things are actual figures one. And all these figures, right, are obtained from the annual reports and of the stock. And these are all these are all figures that you can actually get it from Bursa Malaysia website. So there's no need to speculate. So when you don't need to speculate, you don't need to like calculate the expected PE already. You just have the current, you compare with the past. From there, you decide if this is actually something for you. That one, I believe it's a simple way of looking at it. And this simple way is quite powerful also lah. And I use it quite often when I build my own portfolio. Yeah.
All right. Do you invest in negative PE ratio company?
So PE means to say there's a price divide by earnings, right? So it's so the price cannot be negative. So it has to be E. Okay, actually this whole slide already, this presentation already like explain everything already. All right, so like this one, we only go for stock A. Good enough already. I mean to say, of course, some people want to do the turnaround thing. Some people want to look at the cyclical thing. Some people want to do trading, speculating, macam-macam ada lah. But then that's not my thing, because for me, my capital is, I believe that the efficient way of doing things is just bantai everything in stock A. Just find as many stock A as I possibly can and find the ones that is giving out that is of good valuation. So all the stock, the characteristics is actually very seragam lah. It's like standardized lah. So I don't have a lot of things in my portfolio. I only have one character in my portfolio, which is stock A. And I think good enough.
All right. Thank you so much, Ian, for sharing with us your strategy.
Mhm.
Now, Mr. Yap would like to ask, what kind of PE is considered high enough to sell?
Number one, if the current PE is above its average, that's one way of looking at it. Number two, anything above 30, 40, 50 lah, because really, okay, you can actually use a benchmark lah. Like for example, okay, I'm not too sure whether it's nice. I mean to say we are looking at it from a context of Pasar Malaysia lah. Okay, but sometimes because the world is so huge and then it's so integrated with all kinds of information, even if you want to, let's say you want to look at tech stocks, you want to look at the best of the best tech stocks, let's say Apple and Alphabet and all this, just calculate their PE and compare with them. So if let's say Alphabet, I'm not too sure, if let's say their PE is about 20 plus, and then we have a local tech stock that is where the PE is 50 or 60, then I would say maybe I'll still, maybe there's no reason. I mean to say, if the best of the best, the PE is already at, let's say 20 plus, then why go anything beyond 20? So that's my reasoning.
Okay.
Yeah.
The next question is by Beng Hing. Do we use price to book value as a better valuation method versus price to earnings, or we use both? Can both go in the opposite direction?
I'm not too sure whether it will go in the opposite direction now. But then, because for me, you see here, for me, right, it's the earnings that count lah. Earnings, because the stock is, for me, I'll prioritize on the earnings, because it's the earnings, the income productivity of the stock that matters for me the most. So I will use PE ratio, dividend yields a lot more than PB, but I'll still use PB every now and then. All right. So if you want to make your life simple, right, just do both. No harm doing both anyway.
Okay. We know that a different industry has a different price to earnings benchmark, right? How do we know which one is reasonable? So that's the question by Ang.
Different industry could have different PE ratio. However, it's all in the range of either 10 to 20 or 20 to 30. So even if you go by the average of 20, even let's say you find stocks where, very good stocks where the PE is actually below 20, there's so many of them. So you can actually start shopping from there first. All right. You don't need to actually you don't need to overpay for a stock where the PE ratio is 30, 40, 50. There's so many deals that are in the range of 10, 15, 20, even 20 plus. So anything above 30, 40, 50. Actually, if you think about it, PE ratio 50, you're paying, your price is $50, your earnings is 1. You're taking $50 to make $1. So what's your return? 1 divided by 50, your yield is actually 2%. So why would you want to do that? All right. If let's say if your PE ratio is 20, so at least you're taking $20 to make, you invest $20 to make 1. So maybe your yield will be much higher than a stock that is trading at PE ratio of 50. So you can start with that.
All right. Now, the next question is, if the stocks that we hold has much higher valuation than the competitors in the same industry or sector, shall we sell?
Not necessarily, because there's always a reason why that competitor is of higher premium. But so if that is the case, right, it's best to benchmark the stock with itself. So which means the current compared with its past. Because if these competitors are not so, they are, let's say, number 2 or number 3, or they are number 4, and they're not doing so well, no point comparing that stock with others other competitors where their performance are modest. No need lah. Just compare it with themselves. That will do already.
Okay.
Mm-hmm.
So the next question is, sometimes there are stocks that are making more profits with good growth potential, yet its share price drops or remain stagnant. Why is such a scenario happening?
Overvalue. So a lot of people, you see, a lot of people overvalue the stock. So sometimes we have to look at it from a case by case basis. Sometimes when the stock has good growth potential, making a lot of profits, but then the PE ratio is 70, and then the stock price drop, and then it causes the PE ratio to drop from 70 to 40. Well, it happens. I mean to say, then it's justified lah. All right. So it could be overvalued lah, but I believe that is one of the major reasons. Yep.
Okay, understand.
Mhm.
The next question is by Yesai. So in your opinion, does value investing work in Bursa Malaysia?
Yes. Of course, I'm
It
looking at the
works,
same question lah, but why? Of course, if you should I actually read out the
Sure.
So the original question is like, why value investing doesn't work in Bursa Malaysia? That's because it's part of your belief law. I mean to say, if you have done enough of this kind of compilation, and you have actually compared it with the stock price, if you look at it from a long-term perspective, right, you will find that value investing really works in Malaysia. That opinion, value investing doesn't work in Bursa Malaysia, is for people who didn't really study annual reports. Then of course they will come out with that opinion. So I would suggest all to dig out the annual reports, study the companies themselves, and then you will see that the ones that are fundamentally good, they can actually generate shareholders' wealth to investors. Yeah.
Okay. John would like to ask, how often do you do revaluation?
On and off. I mean to say, every time there's a quarterly report, you can actually do a small revaluation, but it doesn't differ much from the differ much from the valuation 3 months ago. It shouldn't be. All right. So you just monitor that. You just monitor the valuation every 3 months once. Or if you have a habit to do it every day, okay, that's also fair enough. But so you can revalue the stock as many times as you want in the period. Just whatever fits for you will do.
Okay. Kai Kun would like to ask, is there any publication that tracks the company PE over a number of years?
In Bursa Malaysia, that one to me is not so. I believe yes they are, but that's not the major point. If you are just focusing on PE, what's more important is the earnings first. Then we only talk about the PE. So no need to go shortcut. No need all this publication, or no need all these companies. Just go to Bursa Malaysia. Just do all this manual work. It doesn't take a lot of time. All right. Every stock, maybe you just spend about half an hour, 1 hour just to even this one stock, just to plot this graph, it just takes like 5-10 minutes of me. All right. Just do the 5-10 minutes. The 5-10 minutes will save you. You will learn a great deal about the company already. So no need to go for all the companies. Just go to Bursa Malaysia website. Will do. Yep.
All right. So looks like time has run out. So we want to thank Ian for doing this engaging Q&A with us. So let me take over the slide here.
Yeah.
All right. So if you haven't checked out Bursa Academy, you may visit www.bursaacademy.bursamarketplace.com to access all the investing resources that Bursa has prepared for you. It's a one-stop e-learning platform that aims to provide you with a continuous and holistic learning journey. So for our next webinar, it is titled Thematic and Sectoral Investing. So if you want to learn, how do we invest based on key themes and, invest in the sectors that attract the hot money, please join in in this webinar, which is happening on next Wednesday, 10th of August, 8:30 to 10 o'clock. So I've given you the registration link, so you may register here. Okay, I put the registration link in the chat box, so that's where you can register for that. All right. So yes, with that, I would like to thank Mr. Ian Tai, for sharing with us your key criteria to dispose of stocks in your portfolio. So hope all of you here have gotten good values out of this session. So may you all have a great rest of the day. So I have to bid you farewell now. Have a great weekend. Bye, everyone.
All right. Thank you so much, Shane. Bye, everyone. Thanks for participating.
Yes.